So, if you're a startup founder, you know the feeling. You feel this pressure, right? There's this sort of Silicon Valley playbook, a set of rules you're supposed to follow to look and act like a future unicorn. But what if a huge part of that playbook, especially the accounting part, is just a myth? What if it's designed to complicate something that you desperately need to keep simple? Well, let's dig into that. So, where did this whole playbook idea even come from? Well, it all really starts with one massive shift that completely changed how business is done: software as a service, or SaaS. This single idea really laid the foundation for how we think modern startups should operate. Before 1999, if you wanted software, you bought it in a box from a store. But then Salesforce came along and just changed the entire game by delivering their product over the internet. By the 2010s, that subscription model was the new normal, and today it's pretty much how all software gets to us. And this as-a-service idea, man, it was a game changer. It was so powerful, it just started to spread to every other part of the business. And, you guessed it, that brings us to finance as a service, or FaaS. The playbook logic is pretty simple. Why not just apply that exact same as-a-service model to your accounting? Outsource all your bookkeeping to skilled pros in other countries and get these perfect, GAAP-compliant financial statements, that's the official accounting language investors want to see, from the moment you start. On a surface, it sounds like a total no-brainer. And look, the promises? They are super attractive. You get to tap into a global talent pool. You can take advantage of wage arbitrage. We're talking about paying a tiny fraction of the cost for what looks like the same work. And you get this idea of infinite scalability for your finance department. It really seems like the perfect, sleek, modern solution for any lean startup. But is it really? Okay, so let's just pump the brakes for a second. Let's ask a really fundamental question. As a founder, what is your real job? Because this, right here, is where that whole playbook starts to completely fall apart, especially for early-stage companies. I love how the startup legend Steve Blank puts it. He says your job isn't to be a financial engineer or an operations manager. No, you're an artist. Your job is to stare at a completely blank canvas and, through your passion and your focus, create something the world has never seen before, to create a starry night. So here's the real question, right? If your number one job, your entire mission, is to create, why on earth are you deliberately adding all these layers of complexity onto your canvas, especially with your finances, before you absolutely have to? But here's the thing. There's a much, much simpler way to do this. And it's not some new tech bro hack either. It's actually kind of an accountant's secret, a time-tested method that small business pros have been using for decades. And to get it, we just need to understand the two basic ways of looking at your money. Okay, first up is cash basis. It's so intuitive. Money comes in, you record it. Money goes out, you record it. It's literally a mirror of your bank account. Then you've got accrual basis. This one's more complicated because you record revenue when you earn it, not necessarily when the cash hits your account. It's what's required for all the official reports, but man, it is a ton of work to keep up with every single day. So the secret, the real pro move here, isn't to pick one or the other. Nope. It's using this really smart hybrid system called the adjusted cash basis. This way, you get the beautiful simplicity of cash for running your business day to day, and you get the compliance of accrual only when you actually need it. And this is basically what it looks like. And what's so wild is that accountants were doing this, long before software like QuickBooks was even a thing. It's a proven, super efficient system that just works with the data that your bank and credit cards are already creating for you. So here's how it works in 3 dead simple steps. First, you just run your business on a simple cash basis all year long. Super easy. It gives you a real-time pulse on your money. Then, at the end of the year, you just have to isolate the handful of transactions right around that cutoff date. And finally, your accountant makes a few key adjustments, and boom, your books are perfectly compliant for your official reports. It's simple, it's clean, and it's incredibly efficient. So if this method is so simple and it works, why the heck is everyone so obsessed with the complicated, hyped-up playbook? Well, it's because the whole playbook is built on an idea that's just plain wrong. The entire argument for FaaS, for outsourcing all your bookkeeping, is built on this really outdated premise that bookkeeping is just this awful, tedious, manual data entry job. But for a modern small business, that's just not true anymore. Think about this, because this one idea completely changes the game. Small businesses today don't record transactions, they download them. That myth of the terrible data entry job, it's dead. Your bank, your credit card company, they're already doing all the heavy lifting for you. So let's walk through what happens when you follow the playbook and add that offshore team. You think it gets easier, right? Well, you still have to download all your transactions yourself. You still have to scan your own receipts. Then you package it all up, send it offshore, and then you wait. And what you get back are reports that very often are missing crucial local tax context. This doesn't sound simpler at all, does it? Now, compare that whole mess to the simple alternative. Step 1, you download your transactions from the bank. Step 2, you categorize them. That's it. You're done. Seriously, summarizing an entire year's worth of data can take just a few minutes in a spreadsheet. Why would you ever want to insert a complicated middleman? And all of this really brings us back to that first, most important question. What is your real job as a founder? Because I can tell you what it's not. It's not managing some complex international accounting workflow. Okay, get ready for this, because this statistic might actually blow your mind. While the whole Silicon Valley playbook is completely obsessed with venture capital, a full 80% of startups that have a successful exit do it without taking any VC money at all. This tells you that the whole VC-obsessed playbook, it is far from the only way to win. So here's the bottom line, the main takeaway. For most early-stage startups, and I'm talking especially about those with fewer than, say, 20 employees, overcomplicating your accounting is a massive strategic error. Keeping things simple frees up your most valuable resources, your time, your money, and your mental energy, so you can focus on the only thing that actually matters, building that killer new product, creating your starry night on that blank canvas. Look, the adjusted cash basis is simpler, it's cheaper, and for most tax authorities, and even for most early-stage investors, it is absolutely all you need. So the final question I'll leave you with is this. If this part of the playbook is a myth, what other rules are you following right now that might just be holding you back?